McDonald's today announcing it is extending its $5 value meal into December for most U.S. locations. Other fast food companies have tried similar promotions, including restaurant brands and Wendy's. Joining us now is Ron Shaich. He's CEO and managing partner at Act 3 Holdings, board chair at Cava, also the founder and former longtime CEO of Panera. Ron, good to see you again. I want to go
it's been a while. How are you?
Yeah, a little while. I'm doing well. Let's go straight to this McDonald's thing. You say this is a value war and nobody makes money in a value war. So should McDonald's just not be doing this, you think?
Well, I think only the strongest win. If you're betting on price, it's a very difficult place to make a better competitive alternative. The key to the restaurant industry is to get people to walk across the street and choose you, to walk past your competitors and choose your establishment. And if all you've got going for you is price, it's a very tough position to play from.
Yeah, I mean, McDonald's, a lot of these fast food, like cheap options aren't that cheap anymore to my eye. And you're focused on creating a unique niche, right, where customers are willing to spend money. But isn't that still going to be affected by an economic slowdown?
Well, what we're always about in every concept I've been involved in, every business, is building a better competitive alternative, getting people to choose us. In the case of Cava, which has been a phenomenal success, stock's been up sixfold since the IPO, hit an all-time high today. In the case of Cava, it's a powerful category. Mediterranean is the kind of diet people want to eat. It's the number one diet in America for the last 7 years. Cava has the dominant position in it. It's healthy, it's fresh, it's the kinds of foods that excite people today. It brings humanity. It brings an expression of the Mediterranean to its cafes. That's what certain consumers want today. And if we can offer that, we're going to win. That's building a better competitive alternative, not on price, but on something better. In fact, John, I will tell you something. I was just looking at some data. From the high point of the pandemic, fast food's prices are up 30%. The CPI is up 18%. Cava's prices are up 12%. We have pricing power. And when you compare what you get in Cava, where you're getting fresh Mediterranean with exciting and innovative spices that get you charged up, when you compare that to fryer to freezer fast food, you know what the better alternative is.
Ron, it's interesting to hear you break out that data. I would put Cava in the same category as Chipotle and up until maybe not that long ago, even Starbucks. So just to invert this question and this focus on pricing, do want to get your thoughts on what we are seeing at Starbucks, especially as Chipotle's now former CEO, Brian Niccol, has taken the helm.
I so appreciated Brian's letter. I agree with him. The problem for Starbucks is it degraded. It diminished its competitive advantage. That's what Howard was talking about. That's what Brian wants to fix. The problem is that Starbucks once represented something in this country. It was the leader. It was differentiated. It was powerful. You look today, through the pandemic, it turns itself into an automated beverage machine in which its advantage was it could get you through its drive-through quickly. It became fast food. And the agenda for any CEO is to build differentiation, not on the base of being like everybody else and beating them at their own game, but because you're better at your game. And Brian's right. We need to bring back the cafe. We need to bring back humanity to Starbucks. And Starbucks has got to stand out in an ever more competitive market and not on price.
But they did raise prices quite a bit, too. So I do wonder if those need to come down.
Well, they have to be appropriate. Listen, if we're going to pay people right, a living wage, if we're going to have quality food, we have to charge. But take a look at Cava. Our prices have moderated compared to the CPI and absolutely compared to fast food, which is up 30%, CPI up 18%, we're up 12%. Right? We want to give people real value.
How long are workers staying now, say in fast casual compared to the old fast food days? Is there value in trying to get workers to stay longer, to work up through the ranks, et cetera, because it's been sort of a revolving door for much of the industry for a long time?
Well, no, I think that, like everything else, when we talk leadership, we have a great CEO in Brett Schulman. What he's done is build the kind of company people want to stay at. That's what Chick-fil-A did. That's what the best companies in our industry always do. You want to know one of the key metrics in this industry? Don't just look at comps. Look at turnover. That's a leading indicator. What this industry is about is hospitality. And if we're going to have hospitality and humanity, we need to have people that are stable and can stay and care. And so good companies focus on how you do that. They build an environment, they share with their employees, they take care of their employees, they do it in a way that people want to stay. Our employees are not extensions of the cash register. They are not machines.
Okay.
They're human beings. And if we bring them in, they're going to take care of our customers.